What I Learned About Investing from Darwin by Pulak Prasad. Picture this, early 2000s, a hotshot young investor riding high at Warburg Pincus, one of the world's most prestigious private equity firms. He'd already notched a few wins, and honestly, he was feeling pretty invincible. His investing strategy seemed foolproof. Spot a talented entrepreneur building something real, make sure you're not paying through the nose, and boom, you're golden. Then one day, what looked like the opportunity of a lifetime crossed his desk. An Indian company, absolutely crushing it, not just domestically but internationally, which back then was practically unheard of. The founder? Impressive as hell. The client list? Absolutely stellar. He took charge of the due diligence himself, going full detective mode. He practically moved in with the management team, toured every office, interviewed customers across India and Europe, and brought in the best legal, accounting, and forensic experts money could buy to sniff out any possible issues. Everything checked out beautifully. He enthusiastically pitched it to his bosses and got the thumbs up. With pride swelling in his chest, he led a $50 million investment into the company. In India at that time, we're talking absolutely massive money. So, what kind of return did that $50 million bet deliver? Absolutely nothing. The entire investment evaporated. And he knew exactly who to blame. Himself. There was no sugarcoating it. He'd completely blown it. That young investor's name? Pulak Prasad. And here's the twist. That spectacular disaster became the foundation for one of the most fascinating and effective investment philosophies you'll ever encounter. We're not talking about complex Excel models, Bloomberg terminals, or the chaos of trading floors. Instead, his wisdom comes from somewhere far more proven, the 3.5 billion-year track record of life on Earth. Today we're exploring Pulak Prasad's remarkable book, What I Learned About Investing from Darwin. Prasad founded Nalanda Capital, which now manages north of $5 billion. But the truly interesting part isn't the money, it's the method. His entire strategy draws inspiration from Darwinian evolution's timeless principles, and it's been quietly crushing the market for years. Here's what I'm promising you. By the time we're done, investing will look completely different to you. You'll grasp why the most critical investment decision isn't what you buy, but what you refuse to touch. You'll discover the single characteristic that connects wildly successful businesses with nature's greatest survivors. And perhaps most mind-bending of all, you'll learn why building extraordinary wealth isn't about being active or even slightly lazy, but about being extraordinarily, deliberately lazy. This goes way beyond making money. It's about patience, survival, and the deep wisdom embedded in the natural world. It's a story that started with a $50 million faceplant and evolved into a philosophy as powerful and lasting as life itself. Let's kick things off with an uncomfortable truth. The overwhelming majority of professional fund managers, brilliant people from elite schools, controlling trillions of dollars, consistently fail to beat the market. Over 5, 10, or 20-year stretches, somewhere between 75 to 90% of them underperform. Let that sink in for a moment. The exact people getting paid enormous sums to be experts are, on average, worse than a boring index fund. And here's the kicker. According to the data, they're actually getting worse over time. This is the puzzle Pulak Prasad became obsessed with solving. If conventional financial wisdom keeps failing, where should we actually be looking? Prasad discovered his answer in the most unexpected place, thanks to a recommendation from Charlie Munger, Warren Buffett's longtime partner. The book was The Selfish Gene by Richard Dawkins. This single recommendation sent Prasad down a 20-year rabbit hole, devouring everything about evolutionary biology. The deeper he went into Darwin's work, the clearer it became. Nature is the most successful long-term investor in history. Evolution has been successfully compounding returns for billions of years. Its principles, he realized, translated perfectly to investing. This insight sparked the creation of Nalanda Capital's elegantly simple three-step philosophy, a framework that mirrors the fundamental laws of survival and adaptation in nature. The first step, and absolutely the most crucial one, is to avoid big risks. That $50 million disaster burned this lesson into Prasad's brain. In investing, just like in nature, survival comes first. Everything else is secondary. Imagine a deer approaching a watering hole. It's desperately thirsty, but it knows predators could be hiding anywhere. It's hyper-vigilant, seeing potential danger even in shadows. This extreme caution has allowed deer to survive for millions of years. The deer is hardwired to avoid what statisticians call a type 1 error, the error of commission, of doing something that gets you killed. It would much rather make a type 2 error, the error of omission, of missing a chance to drink, than risk its life. Better to go thirsty today and survive to find water tomorrow. This survival instinct is everywhere in nature. A cheetah, the fastest land animal on the planet, won't try tackling a full-grown water buffalo. Too risky. It might get seriously injured or killed. It sticks to smaller, safer prey. Even plants do this. When insects attack, plants divert precious energy away from growth and toward defense, producing things like thorns or nasty-tasting toxins. Survival always beats growth. In investing, this is Warren Buffett's legendary rule number 1, never lose money, and rule number 2, never forget rule number 1. Prasad clarifies this doesn't mean every investment will go up. It means you must obsessively avoid taking big, idiotic risks where you could permanently lose your capital. Your primary goal isn't being a genius stock picker. Your first job is becoming an exceptional rejecter. Prasad shares some simple math that's absolutely mind-blowing. Imagine a market with 4,000 stocks. Let's say 1,000 are decent investments and 3,000 are garbage. Now picture an investor who's remarkably skilled at 80% accuracy. When they spot a good stock, they correctly identify it 80% of the time. When they see a bad stock, they correctly reject it 80% of the time. If this investor makes an investment, what are the odds it's actually good? You'd probably guess 80%, right? Nope, only 57%. Why? Because even with their impressive skill, they still mistakenly approve 20% of those 3,000 terrible stocks. That's 600 bad investments sneaking into their approved pile. They also correctly identify 80% of the 1,000 good stocks, which is 800. So their pile of potential investments contains 400 companies. 600 bad plus 800 good. The probability of picking a winner from that pile is 800 divided by 400, which equals just 57%. But here's where it gets magical. What if that same investor focused on improving just one skill, rejecting bad investments? If they boost their rejection accuracy from 80% to 90%, reducing their type 1 error, their success rate jumps from 57% to 73%. That's a massive improvement. Getting better at saying no is far more powerful than getting better at saying yes. So what does Prasad refuse to touch? He's got a crystal clear list of risks his firm simply won't take. First up, they avoid anyone with questionable integrity, criminals, crooks, and cheats of any variety. As permanent owners, they can't afford partnering with people they don't trust. Life's too short. Second, they steer clear of turnarounds. The fantasy of riding in to rescue a struggling company is seductive, but Prasad quotes Buffett, "When a management with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that remains intact." For every miracle story, like IBM's turnaround under Lou Gerstner, there are countless disasters, like JCPenney under Ron Johnson, the genius behind Apple stores. The odds are terrible. Third, they absolutely hate debt. A heavily indebted company is fragile. In a crisis, it's first in line for bankruptcy. But more importantly, debt strips away a company's flexibility. Prasad tells the story of Asian Paints, India's largest paint company, during the COVID-19 lockdown in 2020. While other companies panicked, slashing staff and costs. Asian Paints, with zero debt and massive cash reserves, did the opposite. They gave employees salary raises to boost morale. They supported their dealers and contractors. This wasn't charity, it was brilliant strategy that built tremendous long-term loyalty. They could only do it because they weren't sweating about interest payments. Finally, they avoid mergers and acquisitions junkies, companies addicted to buying other businesses, and fast-changing industries where identifying the long-term winner is basically impossible. They love stable, predictable, even boring industries. As Prasad puts it, give us electric fans over electric vehicles, boilers over biotech, sanitary ware over semiconductors. By rejecting all these big risks, you'll miss out on the next Tesla or some other rocket ship. You will make type 2 errors. You'll miss opportunities, and that's perfectly okay. Because, like the deer at the watering hole, you will survive. And in investing's long game, survival is everything. This brings us to the second step: buy high quality at a fair price. After filtering out all the risky businesses, how do you identify the truly exceptional ones? Every company has thousands of data points. Where do you even start? Here, Prasad turns to one of the 20th century's most remarkable scientific experiments, the Siberian fox experiment. In the 1950s, deep in Soviet Russia, a scientist named Dmitry Belyaev wanted to understand how our ancestors domesticated animals like dogs. He hypothesized they didn't select for floppy ears or smaller teeth. They selected for just one behavioral trait: tameness. So he launched a massive experiment with silver foxes. Generation after generation, his team bred only the calmest, friendliest foxes. Something incredible happened. Within just a few generations, the foxes started changing in ways nobody had selected for. They began wagging their tails. Their ears flopped over. Their coats developed spots. Their snouts got shorter. They started barking. By selecting for that single trait of tameness, Belyaev got a whole package of other dog-like traits completely free. Prasad asks, what's the investing equivalent of tameness? What's the one measurable trait that, when you select for it, brings a cascade of other high-quality attributes along for the ride? It's not a charismatic chief executive. That's hard to measure and often misleading. It's not explosive revenue growth. Companies can grow themselves straight into bankruptcy. It's not high profit margins. A company can have fantastic margins, but require enormous investments to sustain them. Prasad argues, the single most powerful filter is historical return on capital employed, or ROCE. Don't let the jargon intimidate you. It's straightforward. It measures how much operating profit a business generates for every dollar of capital it uses. A company with consistently high ROCE is like an incredibly efficient financial engine. And like tameness in those foxes, a high ROCE typically signals many other wonderful qualities come free. A company maintaining high ROCE for years, say over 20%, probably has an excellent management team, because maintaining that performance is incredibly difficult without skilled leadership. It likely has a strong competitive advantage, or moat, because competition would have otherwise eroded those high returns, and it signals a business that allocates capital wisely. This single historical filter allows Nalanda to cut through noise and focus only on a small list of potentially exceptional businesses. But there's another layer to quality Prasad learned from evolution: the dual concepts of robustness and evolvability. The living world presents a paradox. Organisms are incredibly resistant to change. Your body plan is robust. You've got 2 arms and 2 legs, and random mutations don't suddenly give you a third. Yet life is also incredibly adaptable. Over millions of years, species evolve dramatically. How can something be both stable and adaptable simultaneously? Prasad points to McKinsey as a business example. The consulting firm has transformed dramatically since its 1920s founding. It operates in new countries, offers new services, hires different kinds of people. Yet its core identity as trusted advisor to chief executives has remained stubbornly unchanged. It's evolved without losing its robustness. This is what we should seek in investments. A robust business has a fortress balance sheet, dominant market position, and stable management team. It can withstand shocks, recessions, pandemics, new competitors, and because it's so robust, it has freedom to evolve by taking small, calculated risks. Think about Walmart. Sam Walton never bet the farm on wild new ideas. He started with one store, then slowly, methodically experimented. He tried new formats like Sam's Club. Some worked, some failed. He expanded internationally through a joint venture in Mexico, testing the waters before diving in. These were calculated risks from a position of strength. Because Walmart was so robust, it could afford to evolve. Evolvability, in business as in nature, comes free with robustness. This brings us to the third and most radical step. Don't be lazy, be very lazy. We live in a world celebrating action. Just do it. In finance, this translates to constant activity, monitoring news, reacting to price movements, frequent trading. The average mutual fund holds a stock for less than 1 year today, down from 7 years in the 1960s. Prasad argues this is a colossal mistake, finding justification in another groundbreaking evolutionary idea, punctuated equilibrium. For over a century after Darwin, scientists were puzzled. If evolution is slow and gradual, the fossil record should overflow with smooth transitional forms. But it doesn't. Instead, fossils show species staying remarkably unchanged for millions of years, a state called stasis, and then, in a geological blink, a new species suddenly appears. For decades, paleontologists assumed the fossil record was simply incomplete, but in 1972, Stephen Jay Gould and Niles Eldredge proposed something radical. What if those gaps weren't gaps at all? What if the absence of evidence was the evidence? What if evolution works in fits and starts? Long periods of stability, punctuated by brief, rare moments of rapid change. Prasad realized this is exactly how business works. Great businesses, he argues, are in stasis. They stay great for a very, very long time. Look at the Fortune 500 from 1955. Over 60 years later, after world wars, technological revolutions, and financial crises, a surprisingly large number of those companies or their descendants remain dominant today. Similarly, bad businesses tend to stay bad. Stasis is the default. So if you're lucky enough to own a truly great business, what should you do? Nothing. You should be extraordinarily lazy. But this laziness has two parts. First, because great companies are rarely available at fair prices, you must be lazy in your buying. You must wait patiently for a punctuation event, a market crash, global panic, a period of intense pessimism. These are rare moments when the market, gripped by fear, offers you an exceptional business at a sensible price. Prasad's own firm proves this. In 14 years, from 2007 to 2021, Nalanda Capital invested nearly half its total capital in just 26 months, all during market crises like 2008 and the COVID-19 pandemic. In March 2020 alone, as the world shut down, they invested more than they had in the previous 5 years combined. They were inactive for years, then, during those punctuation events, acted with incredible speed and conviction. But the second part of laziness is even more important. You must be very lazy in your selling. In fact, Prasad's ideal holding period is forever. Why? This is where he returns to Darwin's most fundamental mathematical insight, the power of compounding. Darwin was first to truly grasp that a tiny 1% advantage, compounded over thousands of generations, creates massive evolutionary change. It's the story of the 24 rabbits released in Australia in 1859. For decades, nothing seemed to happen. But the rabbits kept multiplying, and by the 1920s, their population had exploded to an estimated 10 billion, devastating the continent. The crucial insight isn't just that compounding creates enormous numbers, it's that for a very long time it looks like nothing is happening. And this is precisely why most investors fail. They sell a great business after it doubles or triples, booking a nice profit, but miss the truly explosive growth that comes years or decades later. They don't wait for the rabbits. Prasad shares his own data to prove this. One of his fund's early investments paid for all 7 of its failed investments more than 5 times over, simply because they held on. His biggest regret wasn't a bad investment he made, but a great one he sold too early, a mistake that cost his fund hundreds of millions in foregone gains. The data is crystal clear. A study of nearly 26,000 stocks over 90 years found that just 4% of companies accounted for all net wealth creation in the stock market. A tiny handful of incredible compounders drove all returns. If you're lucky enough to find one, the worst thing you can do is sell it. The wealthiest people in the world, the Buffetts, Zuckerbergs, Waltons, aren't brilliant at selling. They're the ones who founded or bought a great business and never sold. That's the ultimate lazy strategy. And that's the profound lesson from Darwin. The path to building lasting wealth isn't through frantic activity, complex predictions, or chasing the next hot thing. It's through disciplined rejection, patient selection of quality, and then the hardest part, the courage to do nothing. As we step back and absorb the big picture of what I learned about investing from Darwin, what's so powerful is that it's not really a new strategy. It's ancient. It's a philosophy built on principles tested and proven over not just decades, but eons. It's a call to return to a more grounded, patient, and humble way of thinking about building wealth. In a world obsessed with speed, complexity, and forecasting, Pulak Prasad offers a framework rooted in slowness, simplicity, and history. He reminds us we're not smarter than nature. The forces of natural selection, survival, and compounding are far more powerful than any financial model we could build. The most profound lesson for me is the idea of business stasis, that great companies tend to stay great, and mediocre ones tend to stay mediocre. This runs counter to everything we're taught about disruption and the fast-paced modern economy. But the evidence Prasad presents is compelling. This doesn't mean we should be complacent, but it does mean we should deeply respect the enduring power of high-quality businesses. It encourages us to shift our focus from what's next to what has lasted. This book is a masterclass in thinking from first principles. It asks us to look past market noise and see the underlying structures driving long-term success, both in business and nature. It's a reminder that sometimes the wisest action is inaction. So how can you start applying these ideas today, even if you're just beginning? Here are a few simple steps. First, practice becoming a great rejecter. The next time you get excited about an investment idea, a stock, cryptocurrency, anything, force yourself to play devil's advocate. Don't look for reasons it could succeed. Instead, actively hunt for big, deal-breaking risks. Is the company drowning in debt? Is it in a rapidly changing industry where the winner is unclear? Does management have a history you can't fully trust? Make no your default answer, and only change it to yes when evidence is overwhelming. Second, study the past, not the future. Pick a company you admire. Instead of listening to analysts predict next quarter's earnings, find its annual report from 10 years ago. Read what the chief executive promised then. How did the business actually perform over the last decade? Look at its historical ROAS. Has it been a consistent, high-quality compounder, or is its success recent? You'll learn far more from a company's history than from anyone's forecast. And finally, embrace laziness. For just 1 week, commit to not checking daily prices of your investments. Unplug from the 24/7 financial news cycle. Use that time to read a book, learn about an industry, or simply reflect on your long-term goals. See how it feels to focus on the timeless character of businesses you own, rather than their fleeting daily price tag. That was a summary of what I learned about investing from Darwin by Pulak Prasad. We've touched on the core ideas today, but I'll be honest, a summary can only take you so far. The real magic happens when you read the book yourself. It's in those quiet moments when a particular story about a Siberian fox or a struggling company hits you unexpectedly. This summary is designed to help you decide if this book deserves your time. If anything we've discussed today resonated with you, I genuinely encourage you to grab a copy. Reading it isn't just about learning formulas. It's an experience that can genuinely transform how you see business and your own path to building wealth. The link is in the description. Also, if you found this journey valuable, please show your support by hitting that like button and subscribing to the channel. That way, you won't miss our next exploration into another life-changing book from the Billionaire's Bookshelf. Let's keep learning and growing together.